Good morning. It's great to be in Kathmandu, not just because the temperature is much more pleasant than in New Delhi, but I always enjoy coming here because Nepal has a lot of very interesting and exciting policy challenges, but also a lot of opportunities that I always am eager to discuss. And I really enjoyed the debate this morning about this important sector of the economy, the banking sector. I was asked today to speak about the dark side of banking, if you want to say it in a way, or the side that we don't really want to happen, which is when things go wrong. So I put as a title, Better Safe Than Sorry, and I'll talk to you a little bit about what we have learned over the years in terms of a banking crisis, but also how we can prevent it. And at the end, I will talk a little bit about Nepal, and I have to talk about Nepal because I've already been alluded twice here by my previous speaker and also the question here. So I'll give you a little bit of a sense of where we see the achievements that we've made in terms of strengthening the banking framework in this country, and where we still see the potential to improve and to move forward. So let me start. First of all, of course, this is all based on institutional work, but still, I will give you my personal flair here as well, and I'll make two disclosures to tell you about this. First of all, I was a banker myself in an earlier iteration of my life, and second, I've been in the middle of a banking crisis also. I was a resident representative in Uruguay. In 2002, Uruguay suffered a banking crisis, a deposit run. I've seen people with bags going to banks. The system lost almost 40% of its deposit, and it took a big effort to get out of that. So I think my discussion will be a little bit colored by that experience as well, and so I just wanted to get this out up front. Gunnar already talked about the importance of banks for the economy, so I will really go briefly over this. But since you're all bankers, I think and bankers are sometimes or often kind of being singled out. I think my previous discussant said, no, we're being criticized about our returns, or bankers are often kind of being called out. But this is a moment to feel good, I think, because banks really have a huge role to play in the economy. The intermediation of savings really allows to put the capital where it has the highest returns. It contributes to growth and employment creation. And on top of that, banks not only do that, but they also provide very important services in terms of the payment system. So banks are really a fundamental piece of the economy, and it is in the interest of everybody, of the government, of the private sector, to have a well-functioning banking sector, and we should not forget that. So the approach always has to be, of course, to promote a safe and healthy environment in which banking can develop and make its contribution to the economy. Now, this being said, because of the nature of the bank's activities, banks are inherently financially fragile, and Gunnar also spoke about that a little bit, so I think I can go relatively fast. You're all bankers, you know a balance sheet quite well. But of course, as Gunnar mentioned, one of the key issues that banks do is that banks engage in maturity intermediation. So you take short-term deposits and you lend on longer terms, and that creates, of course, a mismatch in the maturity of assets and liabilities. You can see that here in Nepal, liquid assets over deposits is about 23%. Not an unusual number at all. On the contrary, I would agree. Actually, the system in Nepal is quite liquid, which is a good thing. But there's this inherent tensions that banks face, that they have this maturity mismatch, and from which some fragility emerges. You have an asymmetric risk exposure of your asset and liability side to the economic cycle, because your liabilities, they have a fixed price. You guarantee a return on them, but your return on your assets is not guaranteed, and your assets are susceptible to the cycle. So that creates, of course, a fragility for banks. There can be other mismatches on the balance sheet depending on how well the balance sheet is managed. It can be exchange rate, it can be currencies, And of course, I think one of the important things that was just mentioned, and it is really becoming a bigger and bigger issue, is the whole aspect of operational risks, and especially those related to IT, which is, by the way, also an area where we are providing some support here to try to strengthen that aspect. And finally, of course, the fundamental issue is that in a fractional reserve bank system, the capital that is available to support losses is fairly small in relation to the value of assets. So the loss-absorbing capacity of banks is inherently limited. And we can see it here again, if you look capital over assets, in the last data for the Nepalese system is about 11%. Again, that's nothing unusual. This is just the nature of the beast. But what I want to tell you is that banks are inherently financially fragile. And what I will be showing later on is also that when banks fail, there are huge costs, and these costs are not private costs, they're typically socialized, and all of that really justifies a clear policy and regulatory framework for the operation of commercial banks. Now, when we get into problems in banks, there are typically really three basic sources where the problems can come from. And the first one is the macroeconomic and political environment that can create stress. The second one is there can be endogenous factors in the banking sector itself, banking-specific sectors that will create stress. And the third possible source is governance, which was also just mentioned, as an originator of stress, or at least originator of the vulnerability that leads to stress. And usually when banks or banking systems get into trouble, what we see is that there's not just one, but often it's a confluence of factors that come together. So often in banking crises, you have a little bit of all these factors at play. Now let's look a bit more specifically at these issues. Well, the macro side, macroeconomic and political developments, they can really affect both asset and liability side of the banking sector in different ways. I mean, you're bankers, you know that when the economy goes up and down, it affects your balance sheet. Of course, especially if an economy tanks, if economic activity slows, you will see a credit quality decline, of course. You'll have failures of corporates that are borrowing from you. You will see that wages will slow, and therefore consumers become less able to borrow and to service your debts and so on. You can have other types of shock, interest rate shocks if you have imbalances, if you have, of course, mismatches on your interest rate side, exchange rate shocks if you have exchange rate imbalances, capital outflows or liquidity shocks. All of that can affect your balance sheet in different ways between the asset and liability side, and therefore can affect bank earnings, and therefore can affect capital. Commodity shocks often can affect corporates. That will then reflect again in a deterioration of your loan book. And fiscal deficits as well. They can affect the quality of the government bonds that you have, or they may lead to issues such as moral suasion for banks to buy more bonds instead of lending, and therefore your P&E might be affected negatively as well. And then, of course, political uncertainty and instability can upheave really the entire macro environment. So it's very easy to see how the macro environment really affects a bank balance sheet. And often when we have crises, when we have problems, there is a macro component to it. Now, there are often also banking sector weaknesses. We talked, I think, previously about risk management. Well, inadequate risk management is often a key factor. And here I'm talking kind of a system-wide pattern. I'm talking about system-wide weaknesses, the system-wide practice. In terms of funding and liquidity management policies and practices, there can be weaknesses there. In generally, operational risk management, as I mentioned before, is often a factor when we see crises. Weak internal controls, and also interlinkages. That is, we've created connected lending and between business groups, for example, and that often can then lead to very kind of widespread contagion when part of that conglomerate fails. I think one of the key issues here is that poor banking practices in the industry typically are a reflection really of a weak regulatory and supervisory environment. So they usually come together, and on the regulatory side, Of course, prudential rules play a key here, how we evaluate loans and how we limit concentration and different types of risks. In some countries, it's the regulatory parameter, where regulation doesn't really cover all activities, or where there is regulatory arbitrage, and therefore players in the financial sector will move to a certain part of the financial system that is more lightly regulated. The shadow banks, however called at some point. So this is often a cause here or a factor. And then we have weak supervision and enforcement. And often also we have some sort of forbearance and a lack of independence of the supervisor, which is often also at the root of a weak supervisory framework that then leads to poor banking system practices. And they can then make you vulnerable to a crisis. And the third aspect, also already mentioned before, is, of course, inadequate corporate governance. So corporate governance, I think, has been a key issue. We just had, as you will remember, very large fraud in India, but there are issues of incentive structures that are not conducive to maintaining an adequate risk profile, for example. There can be a lack of oversight by boards. And then again, connected lending often plays a role here. And then this is often a consequence of either management not being independent enough or the board not really exercising its fiduciary responsibilities. And fraud, of course, comes together. I would say that the key issue here is that really poor bank governance combined with weak supervisory frameworks, that's a time bomb. That's an accident waiting to happen, and that's what we've often seen around the world as some of the kind of enabling causes for large crises. Now, the main killer of banks around the world remains excessive credit growth. Quite frankly, when we look at crisis cases around the world, high credit growth is one of the most important predictors for banking sector stress. And why is that? Because when credit grows excessively fast, typically lending standards get relaxed by banks. Loan terms are defined without really looking carefully at the funding structure and the funding costs. It's a race to get the credits out, the loans out. Often banks inadvertently in that process take more risks than really their appetite is. And often the risk control framework is not getting updated enough with the massive increase in the volume of operation. Plus, in that process, often new products are created for which the risks are not fully understood. So if we look around the world, as I said, high credit growth has been one of the key killers of banks. And we don't have to look far back. We can look at the global crisis. This shows you the credit to GDP ratio of non-financial private sector debt. And you can see, just look at the orange line, essentially. These are the advanced economies that were hit by the global financial crisis. Some people call it also the North Atlantic crisis because it affected the advanced economies and not at all the emerging markets. Now,